Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, and a lot of news moving the markets, Rob. A lot of news from the Treasury markets to the equity markets to the precious metals markets. And we're actually going to cover all three in that order. So see what I did there? I gave you a, what's that page called when you open a book? You're a book guy. What's that called at the beginning of a book? A synopsis?
It doesn't matter. So 5-year treasuries had the worst auction since COVID. I mean, it was not good. 61 billion came to market. The buyers did not like the yields. Yields popped, even though the market is already expecting rate cuts coming this year. So we've got a problem where we've got more debt than the market wants. We're not offering rates that they want to be paid, and things are changing even in light of the fact that rates are expected lower. So where do you take us from here?
Well, I think it's interesting that a number of months ago we were talking about this before. This isn't the first time in the last few months we've brought up treasuries. And when we saw the auctions, the ones, the twos, the fives, they all did fine. It was the 10s and 20s that nobody wanted.
Right. And the 2-year auction went fine yesterday. I mean, the 2-year auction was not a problem at all. And people were confident that the 5-year would go as swimmingly, but it didn't.
Right. So it seems like that time frame is shortening. The last auction, nobody wanted the 10s and 20s. This auction, nobody wants the 5s, the 10s, or the 20s. So are we going to get to a point where nobody wants the 2s? And that's scary. That's short term.
True.
So that's definitely what I'm going to be watching for the next couple treasury auctions coming up this year, especially if they bring interest rates down. I just don't know if people are buying it.
I don't think they are. I mean, just looking at people and the consumer in general, housing affordability is at all-time lows. Beef is at all-time highs. Milk and eggs are approaching their most recent highs, which were all-time. Consumer credit card debt, all-time highs. Interest rate on credit cards, all-time highs. So the big banks are making a huge amount of money, even though Chase is struggling to close accounts and cancel credit cards, which I don't understand, but that's happening. So the consumer is hurting, and we're looking at a stock market like the S&P 500 that's at all-time highs. But when you break it down, 493 of the S&P 500 are underperforming. You have 7 that are overperforming and 2 companies, Microsoft and NVIDIA, which represent 75% of the gain in the S&P 500 over the last year. Unpack that for me a little bit.
Sure. I mean, you're looking at a company like Microsoft has obviously had a staggering year through 2023, going all the way back to the very beginning of 2023, now up over the last year, almost 84%.
Wow.
Just in a year, which is obviously staggering. And then you look at a company like NVIDIA, you think 85% in a year sounds good. How about 349% in that same period of time?
It's almost like Bitcoin.
Yeah, since January of 2023. I know that there's a graphics processor shortfall that's been going on for a couple of years, but come on, guys. NVIDIA up 31%, which sounds like nothing, but 31% just since about beginning of this year. So you've got a couple companies like that that are just skyrocketing. When across the board, you know, let's say we handpick a couple companies just out of the Dow to make it easy, some of the bigger companies out there. You know, Visa, obviously looking pretty good, but American Express is not. Caterpillar's doing okay. But a number of these companies like Procter & Gamble and Johnson & Johnson and Walmart and Nike and 3M, Coca-Cola, Cisco, Intel, you know, you go down the list and you're, man, these guys are all underperforming. In fact, they're not even back to the previous highs that we hit post-COVID when we had the big influx of money. So when you look at the S&P or the Dow chart by itself, you see what you rightfully assume to believe, a nice average of a broad swath of the entire market. But in reality, you're looking at a very small number of companies propping up everybody else.
Yeah, this is a very narrow market in terms of who is doing what, but there's still more room to the upside, which sounds crazy if we're looking at just a handful of companies moving the market. But if you look at margin debt, I mean, we have 700 billion in margin debt, nowhere near the 1 trillion in margin debt 23 years ago in 2001. So I do expect the market to actually move higher, which sounds crazy, but that's where I think we're going, especially in light of the Fed's talking rate cuts.
And I think the talking rate cuts is probably the thing that is affecting the Treasury market we just talked about. But what also scares me about the talking of rate cuts is there hasn't actually been any cutting of rate cuts. So is this a literal buy the rumor, sell the news type of event we might be looking at this spring?
It could be, but I expect the indexes in the equities market to rise some more. The problem is it's not an everything bubble. Not everything is doing well. I mean, housing prices are stalling out. They're still incredibly unaffordable for the average American. The cost of putting food on the table is at all-time highs, and people are running up their credit cards at all-time high interest rates. I mean, all-time high interest rates going back into the 1970s and 80s. So, the people are hurting. They're not participating in this expansion of wealth.
No. And I think this disassociation between a small handful of companies within the United States having, let's be realistic here, not growth, speculative growth. Speculative stock growth.
Yeah.
It's not company growth. It's speculative stock price growth. When you look at a small handful of companies doing that compared to even everybody else on the S&P 500 or even the Dow 30, let alone looking at something like, say, we were looking at with the Russell 2000, where you're looking at 2,000 of your more small cap looking companies, Russell 2000 still off 15 or 18%. So the broad market as a whole is really struggling right now. And I think, like you're pointing out, everybody's feeling it at the grocery store, at the gas pump, and certainly on your paycheck every 2 weeks.
And with the cost of freight doubling in the last couple of months, that's also going to drive consumer prices higher.
Oh, absolutely.
At a time when people can't afford it.
That's my old Dow theory argument right there. The idea of the Dow industrials, the transportations, leading the industrials.
Yeah.
The idea that if you're not shipping goods, you ain't selling goods. So we can talk speculative stock investing all we want to, but ultimately the stock market is still technically, a view into the health and profitability of the companies on the market. I know that's not entirely why people invest in it anymore. I know there's a lot of chasing the speculation, but realistically, that's why the stock market was invented and technically supposed to be used. I think this disconnect is also the reason why, despite the fact that the equities market are putting in new highs, we're still not seeing a decline in gold yet.
And let's go there because I'm looking at a chart from the Aden sisters, and they're anticipating something very similar to what you and I talked about last week, where we expect gold to retrace back to, say, the 200-day moving average, the 0.5 Fibonacci number. The Adens are looking for gold to break below 2,000 on a very shallow correction. We were thinking somewhere around 1965 to 1985. So you guys are both pretty much in line. So we are going to have probably the next best buying opportunity, even though it's not like it was a few years ago. But if people have money to buy gold, I think they should be getting ready for prices somewhere between 1990 and 1975. What are your charts saying?
So I'm always a fan of the idea of multiple groups of people who adhere to different types of investing or charting strategies, all zeroing in at the same area at the same time. So I've always liked that. I am not an Elliott wave aficionado. Beyond what anybody else does, who does a significant amount of charting. I'm more of what you call like a price action charter, which I can explain sometime if anyone's ever interested. But when you look at the way I look at charts, I'm also looking at levels in the 2020s, which we've now touched and exceeded. My next level down would be, like you mentioned, in the low 1980s. Well, that's going to line up with what you're hearing from the Elliott wave, Pamela and Marianne Aden. discussing a move something shallow below 2000. 1980 is pretty shallow below 2000.
Very.
And you're also going to have your moving averages guy coming in with the 200-day moving average that every day is getting closer and closer to that number. You know, right now it's at 1965. And tomorrow, when one day drops off and we add another one, it's going to be slightly higher. So we could see gold have a pretty modest pullback here.
Right.
I mean, we're just talking gold since September, October, down around 1800 up to 2150.
Right.
Well, you look back where gold started this move, which was really back in like November of 22. It's a real modest pullback. I mean, at this point, you're talking those types of numbers, and you're talking we're down 15, 20% retracement from bottom to top. That's hardly anything.
And that's about as good as I expect it to get. I am not looking for gold any lower than that. So if people are interested, would encourage them to get ready.
Yeah, I completely agree. I think that we're going to have a heck of an opportunity in metals this year, even though the numbers sound a lot higher than they did a couple years ago. You know, I know 1600 sounds better than 1950, but 1600 may be gone. I don't know. We'll see. 2008 was a heck of a year. We had a lot of market things lining up here. And, you know, it was interesting. Through 2007, 2008, the market topped out for a while. It took a bit of time for the market to kind of find that top and inevitably end up having sort of a blow-off sale that was derivative driven at the time. Now, you and I were talking previously, it doesn't sound like the derivatives market is quite the potential catastrophe it was back in 2008.
I agree.
But we are seeing some similarity in the trading pattern in what the S&P and what the Dow were doing then compared to now. So I'm certainly not trying to panic anybody by any means, but I'm a little nervous with Atlas trying to hold up the entire market itself. You know, NVIDIA can only do so much.
Right. It's a pretty narrow participation on the companies that are doing incredibly well. And the rest of us are struggling to just pay the bills.
Well, that's going to do it this week for Golden Rule Radio. As always, if you'd like to speak with one of the advisors at McIlvaney Precious Metals about your precious metals portfolio, give us a call. We can be reached at 800-525-9556. You can also find us on our website at mcilvaney.com. We are on Facebook at McIlvaney Financial and Twitter at ICA Gold. Thanks again for listening and hope you have a great week.